Look, I'm going to be straight with you. While everyone's celebrating their 7% stock market gains, something absolutely massive is happening in the gold market that most people are completely missing. And I'm not talking about some minor price movement. I'm talking about a fundamental shift in the global monetary system that's playing out right in front of us. Central banks just bought more gold in a single year than at any point in the last 5 decades. Let that sink in. The very institutions that print money are dumping their own currencies to buy gold at record pace. What do they know that you don't? Here's what's really happening. The dollar's dominance as the world's reserve currency is being quietly dismantled. Not through some dramatic announcement or international summit. It's happening trade by trade, transaction by transaction, gold bar by gold bar. And the evidence is overwhelming once you know where to look. China's been accumulating gold for years, but recently they've accelerated their purchases to levels we've never seen before. They're not just buying a little here and there. They're systematically building the largest gold reserves outside of the United States. And they're doing it while simultaneously reducing their holdings of U.S. Treasury bonds. That's not a coincidence. That's a strategy. Russia made headlines when they got hit with sanctions. But here's what didn't make headlines. They'd already prepared for this exact scenario by converting a massive portion of their reserves into gold. When Western nations froze their dollar assets, Russia's gold remained untouchable. That lesson wasn't lost on other countries watching from the sidelines. India, Turkey, Poland, Singapore, the list goes on. Central banks across the globe are buying gold like there's no tomorrow. And these aren't small purchases. We're talking about hundreds of tons being absorbed by official institutions, the kind of buying that would normally send prices through the roof in any other market. But here's where it gets really interesting. Despite this unprecedented demand from central banks, despite record buying from Asian consumers, despite supply constraints from mining operations, the gold price has been remarkably controlled. How is that possible? How can you have record demand and constrained supply without explosive price action? The answer lies in the paper gold market. See, there are two gold markets operating simultaneously. There's the physical market where actual metal changes hands, and then there's the paper market where contracts representing gold get traded back and forth. The paper market is roughly 100 times larger than the physical market. Let me repeat that. For every ounce of physical gold that exists, there are about 100 paper claims on that same ounce. This system works fine as long as everyone's content trading paper. But what happens when people start demanding physical delivery? What happens when the music stops and everyone rushes for the exits at once? We're starting to see the cracks. The COMEX, which is the major exchange for gold futures in the United States, has seen its registered gold inventories decline significantly. Registered gold is the metal that's actually available for delivery, and it's been draining at an alarming rate. Meanwhile, eligible gold, which is stored at the exchange but not available for immediate delivery, has been relatively stable. That tells you something important. People are taking delivery. They're converting paper claims into physical metal. The London Bullion Market Association, the LBMA, which handles the majority of global gold trading, has been experiencing similar pressures. There have been reports of delayed deliveries, higher premiums for physical metal, and increasing difficulty sourcing large quantities of gold bars. These are not normal market conditions. These are the conditions you see when supply is genuinely tight. Now let's talk about what's driving this demand beyond just central banks. The average person in Asia has a completely different relationship with gold than the average Westerner. In countries like India and China, gold isn't just an investment. It's savings. It's security. It's how families preserve wealth across generations. And as these economies have grown wealthier, gold demand has exploded. Chinese consumers alone bought over 1,000 tons of gold last year. That's more than the entire annual production of the world's largest gold mining companies. And this isn't speculative buying. This is families converting their savings into something tangible, something that can't be devalued by a central bank's printing press. India's gold demand remains insatiable, despite government attempts to curb imports. Every wedding season, every festival, gold flows into Indian households by the ton. The government has tried import taxes, tried promoting alternatives, but nothing changes the fundamental cultural affinity for physical gold. It's embedded in the society at a level that Western analysts consistently underestimate. Then you have the geopolitical dimension. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been openly discussing alternatives to the dollar-dominated financial system. They've talked about a gold-backed trade currency. They've discussed settling oil transactions in currencies other than dollars. And while these discussions move slowly, the direction is clear. The world is preparing for a multipolar currency system, and gold sits at the center of that preparation. Think about what happened in the 70s. Nixon closed the gold window in 1971, ending the direct convertibility of dollars to gold. What followed was a decade of monetary chaos. Inflation spiraled out of control. The dollar lost more than half its purchasing power. And gold? Gold went from $35 an ounce to over $800 by 1980. That's not a typo. A 22 times increase in less than a decade. We're seeing similar conditions develop today. Massive government deficits, central banks printing money at unprecedented rates, inflation that's proving far stickier than officials predicted, real interest rates that remain negative even after rate hikes. These are the exact conditions that historically have driven gold to new heights. But there's a crucial difference this time. In the 70s, it was primarily Western investors buying gold as an inflation hedge. Today, you have that same dynamic, plus the entire Eastern Hemisphere accumulating gold as a strategic asset. The demand base is exponentially larger. Let me paint you a picture of what's happening in the mining sector, because this is critical to understanding where prices are headed. Gold mining is an incredibly capital-intensive business with long lead times. It takes 7 to 10 years on average to bring a new mine from discovery to production. And the easy gold has already been found. The high-grade deposits that could be mined profitably at lower gold prices are largely depleted. Today's gold mines are processing ore with lower and lower grades. They're going deeper underground. They're operating in more remote and challenging locations. All of this means higher costs. The all-in sustaining cost for many major gold producers is now above $1,300 per ounce. That's what it costs them to pull gold out of the ground, process it, and maintain their operations. At current prices, miners are profitable, but they're not profitable enough to justify massive expansion. The return on investment for new gold projects doesn't compete well with other opportunities. So what's happening? Gold production has essentially plateaued. We're not seeing significant new supply coming online, and existing mines are gradually depleting their reserves. This creates a fundamental supply-demand imbalance. Demand is growing, driven by central banks, Asian consumers, and increasingly Western investors waking up to the monetary instability around them. Supply is stagnant at best, declining at worst. In any other market, this would result in explosive price appreciation. In gold, the paper market has been absorbing the pressure, but that can only last so long. Now, here's something most people don't realize. If you're sitting on retirement savings of $100,000 or more, there are ways to position yourself in physical gold within your retirement accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs actually work, the mechanics of getting physical metal into a tax-advantaged account, and the considerations you need to think through. It's completely free, linked in the description below. If you're concerned about the monetary instability we're discussing and want to understand your options for protecting retirement wealth, it's worth checking out. No pressure, just information if it's relevant to your situation. Back to the bigger picture. Let's talk about what happens when the paper gold market breaks. And I'm not saying if, I'm saying when, because the current structure is mathematically unsustainable. You cannot have 100 paper claims on every physical ounce indefinitely. Eventually, enough people demand delivery that the system can't fulfill its obligations. When that happens, we'll see what's called a short squeeze on a scale that will make previous market dislocations look tiny. The entities that have sold paper gold will be forced to either deliver physical metal they don't have or buy it at any price to cover their positions. And remember, there's not enough physical gold available to satisfy all the paper claims, not even close. The price discovery mechanism will shift from the paper market to the physical market. And in the physical market, gold is far scarcer than current prices reflect. We could see premiums for physical metal explode. We could see delays in delivery stretch from days to weeks to months. We could see a complete breakdown in the orderly functioning of the gold market as it currently exists. This isn't speculation. This is what happens in any market when paper claims exceed physical supply and confidence breaks. We saw it in the silver market in 1980. We saw it in various commodity markets over the years. The gold market is larger and more important, which means when it breaks, the impact will be proportionally larger. Let's examine the ETF market, because this is another piece of the puzzle. Gold ETFs allow investors to gain exposure to gold without holding physical metal. They're convenient, liquid, and easy to trade. But here's the thing. Not all gold ETFs actually hold physical gold. Some use derivatives and futures contracts to track the gold price. And even the ones that do hold physical gold, that gold is held in allocated or unallocated form that may not be immediately accessible to individual investors. Recently, we've seen significant inflows into gold ETFs. Investors are piling in, but we've also seen some interesting divergences. The premium between ETF shares and the net asset value of the underlying gold has been fluctuating more than normal. That suggests stress in the arbitrage mechanism that's supposed to keep ETF prices in line with physical gold prices. If we see a real crisis in the gold market, ETF investors might discover that their paper claims aren't as good as physical possession. There could be delays in redemptions. There could be cash settlements instead of physical delivery. The fine print in these ETF prospectuses often includes clauses that allow for exactly these kinds of scenarios in extraordinary circumstances. Now let's connect this to the broader economic picture. We're living through the largest monetary experiment in human history. Since the 2008 financial crisis, central banks have expanded their balance sheets by trillions of dollars. They've kept interest rates at artificially low levels for over a decade. They've intervened in markets in ways that would have been unthinkable a generation ago. The consequences of this experiment are starting to manifest. Inflation has returned with a vengeance. Not the mild, manageable inflation that central banks target. Real inflation that's eroding purchasing power faster than wages can keep up. The official numbers say inflation is moderating, but anyone who buys groceries, pays rent, or fills up their gas tank knows the real story. Central banks are trapped. If they raise interest rates high enough to truly combat inflation, they'll crash the economy and trigger a debt crisis. Government debt levels are so high that even modest interest rate increases result in unsustainable debt service costs. If they keep rates low, inflation continues to run hot and the currency loses credibility. This is exactly the environment where gold thrives. Gold is nobody's liability. It can't be printed. It can't be devalued by a central bank decision. It's maintained its purchasing power over centuries while every fiat currency has eventually failed. The dollar, the euro, the yen, they're all fiat currencies backed by nothing but confidence in the issuing government. And that confidence is eroding. Look at what's happening in the bond market. U.S. Treasury bonds used to be considered the safest asset in the world, the risk-free rate. But foreign central banks have been net sellers of U.S. Treasuries. They're diversifying away from dollar-denominated assets. And who can blame them? When you're holding an asset that's guaranteed to lose purchasing power to inflation, that's not risk-free. That's guaranteed loss. The yield curve has been inverted for an extended period. That's historically been one of the most reliable recession indicators. But this time, the recession hasn't materialized in the traditional sense. Instead, we're seeing a slow-motion deterioration in economic fundamentals. Real wages declining, savings rates collapsing, consumer debt reaching record levels. These are not the signs of a healthy economy. Corporate debt is another ticking time bomb. Companies borrowed heavily when interest rates were near zero. Now those debts need to be refinanced at much higher rates. Many companies that looked financially sound at 2% interest rates are struggling at 6% or 7%. We're going to see a wave of corporate defaults and bankruptcies, and when that happens, the flight to safety will intensify. Gold is the ultimate safe haven, not because it generates yield or cash flow, but because it's the one asset that maintains its value when everything else is falling apart. In times of crisis, gold is liquidity. It's accepted everywhere. It's recognized as valuable across all cultures and throughout all of history. Think about the wealthy families that have preserved their wealth across generations. They don't do it by holding cash. They don't do it by staying fully invested in stocks. They maintain a core position in physical gold and other hard assets. It's the foundation of their wealth preservation strategy. And there's a reason for that. It works. The gold-to-silver ratio is another indicator worth watching. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Recently, this ratio has been elevated, sometimes reaching 80 or 90 to 1. That suggests silver is undervalued relative to gold, and silver has its own supply-demand dynamics that are even more compelling than gold in some ways. Silver is both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and countless other industrial processes. Unlike gold, which is mostly recycled and reused, silver gets consumed in industrial applications. It's gone. And yet, silver mining production has been declining. We're facing a structural deficit in the silver market where consumption exceeds production. When gold starts its next major leg up, silver typically outperforms on a percentage basis. It's more volatile, which means bigger gains in bull markets and bigger losses in bear markets. But for investors who understand the dynamics and can handle the volatility, silver offers compelling upside potential. Let's talk about the mechanics of how gold moves from weak hands to strong hands. During periods of price consolidation or decline, retail investors get shaken out. They bought high, they're sitting on losses, and they capitulate. They sell to stop the pain. Who's buying? Central banks, sovereign wealth funds, ultra-high net worth individuals. The smart money accumulates when prices are weak and sentiment is negative. Then, when the fundamentals finally overwhelm the paper market manipulation, prices start to rise. Retail investors who sold low start to feel FOMO. They buy back in at higher prices. The cycle repeats. This is how wealth gets transferred from those who don't understand the game to those who do. The key is to be positioned before the crowd realizes what's happening. Once gold is making headlines and everyone's talking about it, you've missed the easy gains. The time to accumulate is when it's boring, when nobody cares, when the financial media is declaring gold dead for the 100th time. We're approaching an inflection point. The signs are everywhere if you know what to look for. Physical premiums are rising. Delivery times are extending. Central bank buying continues unabated. Mine supply is constrained. ETF inflows are accelerating. The paper market is showing signs of stress. These are not random occurrences. They're all pointing in the same direction. The question isn't whether gold is going higher. The question is how high and how fast. Conservative estimates based on historical precedents and current monetary conditions suggest gold could easily double from current levels. More aggressive projections, accounting for a potential breakdown in the paper gold market and a full-blown currency crisis, suggest multiples of current prices. But here's what you need to understand. This isn't about getting rich quick. This is about preserving wealth in an environment where currencies are being systematically debased. If gold doubles but the dollar loses half its purchasing power, you haven't made money in real terms. You've just maintained your wealth. That's the real function of gold. It's insurance. It's preservation. It's the anchor in a storm of monetary chaos. The wealthy understand this instinctively. That's why they maintain gold positions regardless of short-term price movements. They're not trading in and out trying to time the market. They're holding a core position as a permanent part of their wealth structure. And they're accumulating more when opportunities present themselves. You're watching the end of an era, the era of unchecked fiat currency expansion, the era of dollar hegemony, the era of paper gold price suppression. What comes next is a repricing of gold relative to the massive expansion in money supply that's occurred over the past 15 years. And that repricing is going to shock people who haven't been paying attention. The central banks know this. That's why they're buying. The sovereign wealth funds know this. That's why they're accumulating. The ultra-wealthy know this. That's why they maintain significant gold positions. The question is, do you know this? And more importantly, are you positioned accordingly? This isn't financial advice. I'm not telling you what to do with your money. I'm laying out the facts as I see them based on decades of studying monetary history and market dynamics. What you do with this information is entirely up to you. But I will say this. In times of monetary instability, those who hold hard assets fare better than those who hold paper promises. That's not theory. That's history. And history has a way of repeating itself, especially when it comes to the inevitable failure of fiat currency systems. The transition we're living through won't be smooth. There will be volatility. There will be moments of panic. There will be policy responses that create temporary dislocations. But the underlying trend is clear. Gold is reasserting itself as the ultimate form of money, the form of money that has survived every empire, every currency collapse, every financial crisis throughout human history. Cash is a depreciating asset in an inflationary environment. Every day you hold it, you're losing purchasing power. Gold is the antidote. It's not about making a bet. It's about protecting what you've worked your entire life to build. It's about ensuring that your wealth survives the monetary chaos that's unfolding around us. The choice is yours, but the clock is ticking, and the longer you wait, the more expensive that insurance becomes.